Right now, something unusual is unfolding in the silver market, something that almost nobody is paying attention to. The biggest players who have been betting against silver for years are suddenly backing away, quietly, rapidly. Nearly half of the largest short positions have disappeared since 2024. That doesn't happen in a normal market. When prices rise, short sellers usually double down, but this time they're doing the opposite. They're exiting. At the same moment, physical silver deliveries are exploding to levels never recorded before. Something big is shifting behind the scenes, and when you see the data, you'll understand why this moment could change the silver market for years. For more than a decade, silver has lived under a strange contradiction. On one side, the demand for silver has steadily grown. Industries need it for solar panels, electronics, medical technology, and dozens of other modern applications. At the same time, investors treat silver as a precious metal, a form of financial insurance against inflation, economic instability, and currency weakness. With demand coming from both industry and investors, you would expect silver prices to behave the way gold often does during uncertain economic periods, rising steadily as demand increases. But that's not what happened. Instead, silver spent years trapped below key price levels. Every time the metal started gaining momentum, the rally would suddenly stall. Prices would surge for a few weeks or months, only to be pushed back down again. Many investors noticed this pattern. It looked like silver was constantly running into an invisible ceiling. That ceiling was the futures market. Large financial institutions, particularly commercial traders and major banks, held enormous short positions in silver futures. A short position is essentially a bet that the price will fall. When these positions become large enough, they can create enormous selling pressure on the market. And for years, the silver market was dominated by exactly that dynamic. A handful of massive traders controlled an unusually large percentage of the entire short side of the market. Every time prices started rising, additional short contracts appeared. That increased supply in the paper market often prevented silver from breaking through critical price levels. The result was a market where real-world demand kept increasing, yet prices struggled to reflect that demand. This imbalance created frustration for investors and confusion for analysts. If silver was so important for modern industry, and if inflation was pushing up prices across the economy, why wasn't silver responding the same way other commodities were? The answer appeared to lie in the difference between paper silver and physical silver. The futures market allows traders to buy and sell enormous amounts of silver contracts without ever touching the metal itself. For years, the paper market became vastly larger than the actual physical supply of silver sitting in vaults. And that imbalance worked until recently, because now something inside the system is starting to shift, and the biggest short sellers appear to be preparing for it. Over the past 2 years, a pattern has emerged in the market data that very few people are talking about. The largest commercial traders, those same institutions that historically held the biggest short positions, have begun steadily reducing their exposure. Not slightly, not gradually. They have cut massive portions of their short bets. At the same time, silver prices have been climbing sharply. That combination is extremely unusual. In a typical market cycle, when prices rise, short sellers increase their bets. They assume the rally is temporary and expect a correction. By adding new short positions at higher prices, they position themselves to profit when the market eventually pulls back. But the opposite is happening now. Instead of increasing short positions, these major traders are closing them. They are stepping aside. Why? There are only a few realistic explanations. The first possibility is that the losses are becoming too large to sustain. Rising prices would force short sellers to buy back contracts to limit their damage. The second possibility is even more interesting. They may believe the price of silver is heading significantly higher, and they don't want to be trapped on the wrong side of the move. But is another piece of data that makes this situation even more intriguing. Physical silver deliveries are surging. In futures markets, most contracts are settled financially. Traders rarely demand the actual metal, but when investors start requesting physical delivery, the system must provide real silver from exchange vaults. And recently, those delivery numbers have exploded. In fact, the amount of silver leaving exchange vaults through the delivery process has reached the highest levels ever recorded. This is happening while the available registered inventory continues shrinking. In simple terms, more people are demanding real silver while the supply available to deliver is getting smaller. When that situation develops inside a market dominated by large, short positions, it creates the conditions for something powerful, a short squeeze, and the data suggests the setup for one may already be forming. To really understand what's happening in the silver market right now, you have to understand how the system behind it actually works. Most people imagine the silver market as a place where buyers and sellers exchange physical metal. Someone wants silver, someone else sells it, and the price changes depending on supply and demand. But that's not how the modern silver market primarily functions. Today, the majority of silver trading happens through futures contracts. These are financial agreements that represent silver, but they don't necessarily involve the movement of physical metal. Traders buy and sell these contracts every day, sometimes holding them for only minutes or hours. Because of this system, the amount of paper silver traded on exchanges is enormous compared to the actual silver stored in vaults. In fact, there are often several times more paper claims on silver than the physical supply available for delivery. For years, this structure allowed large institutions to dominate the market. A small group of powerful traders held extremely large short positions. A short position means they were betting that silver prices would fall. Whenever the price started rising too quickly, new short contracts would appear in the market. This increased the selling pressure and often pushed the price back down. It created a pattern that repeated itself again and again. Silver would start rallying. Investors would become excited. Momentum would build. Then suddenly the rally would slow down or reverse. To many observers, it looked like silver was hitting an invisible wall. That wall was the massive short exposure held by large commercial traders. But something began changing around 2024. Market reports that track trader positions started showing something unusual. The biggest short sellers were slowly reducing their positions. At first, the change seemed small, but over time it became impossible to ignore. Instead of increasing short positions as prices climbed, these large traders were quietly closing them. That behavior is extremely unusual. In most markets, when prices rise sharply, short sellers step in to bet against the rally. They assume the price has gone too far and will eventually pull back. But this time, many of the biggest players appear to be stepping away from that strategy. And while that was happening, another trend was developing at the same time. Demand for physical silver deliveries began increasing. On futures exchanges, most traders closed their positions before delivery. They settle the contract financially rather than requesting the actual metal. But when someone decides to take delivery, the exchange must provide real silver from its registered inventory. For years, delivery volumes remained relatively stable. Then recently, they started rising, and not just slightly. Delivery requests began reaching levels that were significantly higher than historical averages. Charts tracking these deliveries show a dramatic change. Bars representing recent months are far taller than anything seen over the past decade. Even during major global events, such as the economic disruptions of 2020, the delivery numbers never reached the levels they are reaching now. At the same time, the amount of registered silver available in exchange vaults has been declining. Registered inventory represents the silver that can actually be delivered to fulfill futures contracts. When that number drops, while delivery demand rises, it creates a tightening supply situation. Imagine a system where many traders hold paper claims on silver, but the amount of physical metal backing those claims is shrinking. As long as most traders are satisfied with paper settlements, the system works smoothly. But when more participants start requesting the physical metal, the imbalance becomes visible. Every ounce that leaves the vault reduces the supply available for future deliveries. And if that trend continues long enough, the market can start reacting in powerful ways. This is where short sellers begin to feel pressure. When traders hold short positions, they profit if the price falls. But if the price rises, their potential losses grow larger. Normally, short sellers manage this risk easily because the market remains liquid and stable. But if prices rise quickly while physical demand drains available supply, the situation becomes much more dangerous for those holding short bets. Because if too many investors demand physical delivery while supply is limited, short sellers may be forced to buy back their positions. And when large numbers of shorts buy back contracts at the same time, prices can rise very quickly. This phenomenon is known as a short squeeze. Short squeezes have occurred in many markets throughout financial history. They often begin quietly. At first, only a few traders close positions. Then prices move higher. More short sellers start covering their bets. That buying pushes prices even higher. Eventually, the cycle feeds on itself. Prices rise not just because of new buyers, but because existing short sellers are forced to exit their positions. The result can be extremely rapid price movements. And right now, several signals suggest the silver market could be entering the early stages of this type of setup. Large short positions are shrinking. Physical delivery demand is surging. Exchange inventories are tightening. And the global economic environment is increasing interest in precious metals. When all of these factors appear together, they can create powerful momentum. No one can predict the exact timing of how markets will react. But when the structure beneath the market begins changing, the effects can eventually become visible in price movements. And that may be exactly what is beginning to unfold in the silver market today. When you step back and connect all the pieces, the picture that forms is extremely powerful. For years, the silver market has been dominated by large, short positions. A small number of powerful financial institutions held enormous bets that the price of silver would stay under control. Those positions created constant selling pressure in the futures market, and that pressure acted like a ceiling above the price. But now that ceiling is starting to weaken. Data from trader positioning reports shows that the largest short sellers have been steadily reducing their exposure. They are not adding more short bets the way they did in the past. Instead, they are closing positions and stepping away from the trade. That change alone shifts the balance of power in the market. When the biggest sellers reduce their influence, prices gain more freedom to move based on actual supply and demand. At the same time, another powerful force is emerging: the surge in physical silver demand. Delivery data shows that record amounts of silver are being removed from exchange vaults through the futures delivery process. Every ounce taken from those vaults reduces the amount of metal available for future contracts. And that matters because the silver futures market operates with far more paper claims than physical supply. As long as most traders are comfortable settling contracts with cash, the system works smoothly. But when large numbers of investors start requesting the real metal, the imbalance becomes visible. That is exactly what appears to be happening now. Physical deliveries are rising while registered inventory is falling. In simple terms, more investors want the metal, and there is less metal available to deliver. When that situation develops in a market where many traders are still holding short positions, the risk of a short squeeze becomes very real. A short squeeze happens when rising prices force short sellers to buy back their positions to limit losses. That buying creates additional upward pressure on the market. The more prices rise, the more short sellers feel pressure to exit. And the more they exit, the higher prices can climb. It becomes a chain reaction. What makes the current setup even more interesting is that the technical chart for silver is showing a strong bullish structure at the same time. For months, silver prices have been moving within an upward trend. Each time the market pulls back, it finds support at higher levels than before. This pattern suggests that buyers are gradually gaining control. In technical analysis, this type of pattern often signals accumulation. Large investors slowly build positions during these periods, preparing for a larger move later. If the price continues respecting that upward trend line, many analysts believe silver could eventually challenge its previous all-time highs. And if a short squeeze develops during that breakout, the move could accelerate far faster than most people expect. Historically, short squeezes rarely produce slow, predictable rallies. They often create explosive price moves where the market rises dramatically in a short period of time. Prices can surge higher as short sellers rush to exit positions and new buyers jump in. But the most important thing to understand is that short squeezes don't start suddenly. They build quietly beneath the surface, positions shift, supply tightens, demand increases, and eventually the pressure becomes too strong to contain. Right now, several of those signals are appearing in the silver market at the same time. Short positions are shrinking, physical demand is rising, inventory levels are tightening, and price structure is trending upward. When these factors align together, they often mark the beginning of a much larger story in the market. And if the current trend continues, the silver market may be approaching one of the most important turning points it has seen in many years. So now the question becomes simple. What happens next? Will silver continue building pressure until a major breakout occurs? Or will the market find a way to stabilize before reaching that point? The coming months may provide the answer. If physical delivery demand continues rising while short positions keep shrinking, the balance of supply and demand could shift dramatically. But markets are never perfectly predictable. Unexpected events, economic news, geopolitical developments, central bank decisions can all influence price movements. That's why discussions like this matter. Different investors see different signals in the same data. Some believe silver is preparing for one of the biggest moves in decades. Others think the market still needs more time before any major breakout happens. So I want to hear your perspective. Do you believe a silver squeeze is already underway, or do you think the market is still building toward that moment? Share your thoughts and analysis. Conversations like this help investors learn from each other, and sometimes the most valuable insights come directly from the community. Before we finish, remember the key signals that started this entire discussion. The largest short positions in the silver market are shrinking. Physical delivery demand has reached historic levels. Exchange inventories are declining, and the broader economic environment is becoming increasingly supportive of precious metals. Each of these factors alone would be significant. Together, they suggest that something deeper may be unfolding beneath the surface of the market. If the trend continues, the silver market could be approaching one of its most important turning points in years. But the real story isn't just about price, it's about structure. For decades, silver prices were largely shaped by paper trading in futures markets. Now, physical demand appears to be playing a much larger role. And when physical supply and demand begin driving price discovery, markets can change very quickly. So keep watching the data. Watch the deliveries, watch the inventories, watch the positioning of the biggest traders, because those signals often reveal major shifts long before they appear in headlines. And if the current pattern continues, the next chapter in the silver story may already be beginning.